All right, everybody. Well, here we are. We're coming around to the end of August. Another Profit Strategies or Power Profit podcast with me as he is every week, except for last week. We took that week off. Chris
Yeah.
Johnson.
Hey, Tom, how are you, man?
I'm good. Celebrated a birthday over here at the Gentile house. My youngest, yes, turned 25. 25, man. Crazy.
Wow.
I feel my age when I start talking about my kids every time they have a birthday.
Well, my oldest hit 30, and it was one of those moments where I kind of sat there and went, "Oh, if he's 30, what? Oh, wow!" But you guys had a lot of fun at the birthday party, the festivities, right?
Yeah. We had fun, all right.
Yeah.
So, by the way, how was your week? What'd you do during your off time?
You know what? I was down there catching a little bit of sun in Florida. I went down and saw my son, my middle child, and wasn't that far from you. It's always good to get out of town. I need to figure out a way to get down there much more often. I mean, it's great being down there. Yeah, I was
Well,
down
yeah,
in
this week it finally it didn't cool off. It just got a little less humid. And, we are looking forward to getting out of this excessive heat summer. If you want to come down, the best time to come down, is coming soon. I think the best time to get down here is in that November, December, or December, January, February time when hurricane season is over and it's nice and cool. And, we got the bonfires going on in the back. We'll have you over, do a little, little s'mores. S'mores and alcohol.
There's nothing wrong with that combination. It's funny. I flew back and you mentioned your heat bubble down there. I believe I'm probably warmer in Cincinnati right now than you are. We're 98 degrees at 11:30 in the morning, and tomorrow we're supposed to get to 103. So
crazy.
I didn't get
Absolutely
a break by coming north.
It's like that around the entire middle of the country right now. So we are actually cooler than most of the middle of the country. So hey, let's start talking about some hot topics here. We have 3 topics I want to talk about in this podcast. I want to talk about the markets real quick and what's going on over in Jackson Hole, because that's one area I don't think it's as hot as the middle of the country. Although it's heating up over there for other reasons. We still have a few earnings reports that are coming out. And I'm going to give everyone my top three bearish picks going into the next couple weeks. And then, of course, there was an article that I read about Generation X that I want to finish up on. So let's go ahead and start with the markets. And, Chris, it's been another one of those topsy-turvy weeks.
Yep.
But everybody's looking to Jackson Hole, which is kind of happening as we speak. So, what do you see going on over there? What's the outcome, and where do you see the markets going?
I think the outcome is going to be more of the same, Tom. The Fed has been delivering, and everybody's been, pointing their finger at the Fed and saying, you guys are screwing things up, or you guys are mismanaging your messages. The Fed's been telling us higher for longer for a long time. Jerome Powell, to his credit, has delivered that message consistently for the last, 6-7 months or so?
Yeah.
And I think you're going to hear more of the same. They're going to be very sensitive to what is going on. They've made it clear that, there could be a situation here where we do see inflation start to raise its head. And look at crude oil prices, man. They're going up. Housing prices haven't come back.
That's the only thing that I've seen for the better part of the week that has moved in the upward direction.
Yeah.
It's one of the few commodities that has moved up. Because, everything else has been opposite of bonds or been opposite of yield. And so, I'm looking at some information here. The market must have thought Jerome Powell was lying. Isn't that what you feel like? I mean, it's like you're right. He kept saying we're gonna be ahead of inflation. We're gonna be ahead of inflation, and the market was like, they're done. He's just saying this, and now the markets over the last couple of weeks have kind of said, no, you know what? He's not done.
It was the tail wagging the dog, or trying to wag the dog. When you looked at the equity markets, they ran up with just fury.
But the bond market didn't start dropping I mean, it's been dropping. I mean, you take a look at TLT, it's just been, kind of in a straight line
Right.
down. But it really started, it was like going off the ocean shelf in the last week or two, because everyone all of a sudden realized that the Fed is maybe not be done yet, and forget about these rate cuts that the market was already pricing in. Now they're like, oh man, we might have another hike or so before they get to cutting. And then it's like TLT caught up with the Fed. That's the best way I can put it.
I think you're exactly right. And that 10-year yield, which obviously there's a relationship there between, even though it's 20-year on TLT, man, that 10-year yield, once it hit that 4%, did not look back this time. And I think it's exactly what you're saying. It's everybody kind of waking up and going, oh, maybe he wasn't bluffing.
Yeah.
Maybe he really is. Maybe they're going to go for another 25 or maybe even 50. So that's probably caused, that's, I think, at the root of the market's, continuation on its pullback here. The other thing, Tom, is look at those regional banks. If you look at the KRE, which I think gives you a good view of two things here. First of all, the risk that is still out there in the market. And second, the view of the Fed. Because if the Fed goes another 25 or even 50, let's say maybe they could go another 50 basis points, those banks are getting squeezed right now.
That brings up a good question, because we've been talking about this for the last couple of weeks. What's your feeling on the banks and banks, brokers, insurance companies? Do you still like them long term?
I do like them long term. I think you're still going to get some opportunities to get them at lower prices. The regional banks are in the crosshair because commercial loans are down, housing loans are down, and they're down simply because rates are higher and there's no inventory out there to write loans on. And at the same time, so that's their income side.
Well, that, and also the only inventory that is out there is new construction. And some of these guys, these guys got tricks that are better than circus animals. When you look at like Toll Brothers and Lennar, they're doing everything from credits at closing to, they're in some cases, some of these guys are even the bank. They're offering better than mortgage rate loans because they're able to. That's why.
And I saw this yesterday. Smallest inventory of homes out there for purchase in 22 years. So you have to go back to almost 2000 to find this small amount of inventory, either new home or existing homes on the market.
And that might be countrywide, but you look at Florida, and what I'm seeing is I am seeing a slowdown in existing home sales. And the reason why is because everybody's kind of gone back to, why would I buy someone else's house when I can buy a new house? Because the inventories here, at least in Southwest Florida, are actually starting to increase a little bit. I mean, just, the retirement capital of the world, and they can't stop there. Okay. So, what we'll do is, folks, we're going to take a look at September as a whole next week when we get into the first week of September, because we do get into the first week of September at the end of next week. So we'll take a look at where the entire month of September goes. But do you see, Chris, coming out of Jackson Hole into next week, do you see volatility expanding, or do you see everyone finally breathing a sigh of relief because this is out of the way?
No, I think Jackson Hole is just going to be kind of a little bit of maybe a pause at best. Let's face it. I mean, the market right now is not being driven. In my opinion, not being driven by sitting on the edge of their seat for Jackson Hole. We're coming off a sentiment high. I mean, everybody was buying heavily into July. They got very greedy. And then when we hit August, it's a seasonal slump. I mean, August and September usually, and we'll talk about that September, but I think this is just a natural progression of the market. The Fed could cause a little bit of volatility next week, but I think we're more likely to see NVIDIA, today after hours cause more volatility than what the Fed does.
Right.
How about you?
You have to be real careful for those of you watching the podcast. You got to be careful because, there's a lot of stuff. A lot of people get their news from different sources. I think it's 50% of people now get their news from social media, which I think is the absolute worst way to get news. Because, you got a lot of people out there that are they're completely one-sided. Like I saw this thing that said national banks are going under, and we're gonna have the violence that's happening in the country is just going to continue, and it's going to be the haves versus the have-nots, and then you've got BlackRock controls everything, and I mean you get into that, and you can really get down into a really, really dark hole. I'm kind of with you, Chris. I think that there's going to be some regional banks that are going to get snuffed out over the next several months, because it started this year, and I think there's like a little bit of a pause. But like my mother's always said, when you see one cockroach in the kitchen, there's a lot more that are under the floorboard that have not yet come out, and so we could call that some regional banks that got ahead of themselves because they don't have a huge board that they got to go to. That maybe they made it through 2008, and now they think they're Teflon. And only now are they starting to realize, wait a minute, we overcommitted here, or we overcommitted there. Let's see if we can ride the tide out. I think some of those are still able to come out, but then you've got the big guys. Not just the Bank of Americas, but you got insurance companies out there that that are national brands, and you got brokerage firms like Schwab, for instance, national brand that's down. That I think are gonna have some long. They're going to come back. It might take a little time, but I think they're going to come back. I'm with you. Various reasons the market dropped. We talked about Fitch's downgrade last week. We talked about J.P. Morgan on their radar. We talked about seasonality. You take a look at credit card interest rates. I mean, does it shock you? Average credit card rates, average rates are at 20%, but every credit card I'm looking at these days, it's closer to 30.
27, 29. Yep.
29.99 I saw.
It's insane.
It absolutely is. Why in the world would someone want to get themselves locked into something like that? I mean, the real crooks, we used to say politicians were the real crooks. Not anymore. It's the credit card companies.
Credit card bankers.
Unbelievable. I mean, I feel like I'm in the wrong business. Because
extrapolate that out for a second. And, we're going to talk about earnings in a few minutes, but the message that you've heard over the last week from some of these retailers, these very large retailers, goes along with that credit card situation. They are seeing the retailers, the average retailer that's getting squeezed and saying, hey, we don't know if we can keep people coming in the door when they're paying 30% to float a credit card, when they're paying, higher amounts on their mortgage. I mean, the interest rate situation is now really extrapolating itself out beyond just headlines and, people who sit up on Wall Street and say, well, this could happen, to we've gone from inflation. I don't know. Can we put together some sort of word here? We got inflation that drove it last year, and now you've got interestflation that is, maybe coming in 2020, second half of 2023, and going to squash.
And so, what has this done to the markets? Well, for those of you that can visualize this in your head, we broke a key resistance level or support level. That's now become resistance, 50-day moving average. 50-day moving average on the SPY, which is the ETF for the S&P 500, is around 445. All right, well, we broke that, and we dropped well into the 30s for getting a little bit of rebound, but that's now resistance. So when you look at the SPY, folks, 445 is going to be a very key resistance area, and it's not just the moving average. It's not just the moving average, but when you get to it, wherever you're going, if you're listening to this in your car, if you're listening to this while you're falling asleep, I mean, Chris and I got some really nice monotone, sleepy voices. It's fine. But when you wake up or you get where you're going, pull a chart up of SPY. I want you to take a look at the resistance points back in June, back in July, and then the support points that happened just a week ago. And you can see all those are tying together right around the 445 area. So 445 is a really interesting level for the S&P. I mean, that to me, right now is a bearish indicator, because we could go up and we could hit that. We've got to get through that and close through that before that turns. But I do think that's a short-term bearish indicator. Also, we talked about August. August is a mixed month when it comes to seasonality. Now, the markets could go anywhere from here, Chris, but I think it's always a good idea to align yourself with the market itself. No reason to trade against it until it's time to go against it, because it's going against you. We also know that some stocks go up, some stocks go down against the overall trends. But if we are in an area now where we're starting to see potentially, at least for the short term, little lower highs or little lower lows, start looking at stocks that might be aligned that way, or could be the dog. If this is the tail, it could be the dog. And so I want to give everybody 3 bearish candidates for the short term. All right. First one I want to talk about is Titan Machinery. The symbol is TITN. Pull up a chart of TITN and you'll see what I'm talking about. This is a company that had the last earnings report they had. Stock was trading around 35. Within a week later, it was down to 25. That's a pretty big move, going from 35 to 25. But more importantly, they too are below their 50-day moving average. All right. That, and if you look at the history, because, I'm America's pattern trader, Chris. So that's what I'm talking about. Historically, this one drops into earnings, and we're going into earnings with Titan. We got probably about a little more, around a week. We got about a week to earnings. So that's something to look at. All right, here's number 2, Smartsheet. All right. The symbol for Smartsheet, this is a NASDAQ stock, SMAR. The technicals are decidedly bearish. Look at the last earnings report on these guys. They gapped lower. They went from 52 down to 40, just like that. And they've literally kind of been range trading for the last 3 months from around 38 to 44. They haven't gone above 44. They haven't gone below 38. But they're going back down, getting close to that 38. And they're also below that 50-day moving average. And they also had something called the death cross. The death cross is when you have the 50 and the 200 crossing in the wrong direction. The 50s crossing below the 200. So we've got some areas of resistance on SMAR. I call it SMAR, S-M-A-R. It historically drops into earnings too. And the other interesting thing that if you take a look at a chart, folks, of SMAR, you'll notice that the option traders are getting more and more nervous. Now, this one's about 2 weeks into earnings. So, keep an eye on that one. Finally, one of my favorite stores to never shop at is Restoration Hardware. I don't know about you, Chris.
Oh, my gosh.
But, oh, my God, the overpriced furniture at that place. They got some nice stuff. Oh. But, the cheapness in me is like, no, I'll just keep the stuff I already have. They have, if you were to look at Restoration Hardware, you'll see this is a different kind of chart, because it's been mostly up for the year. But it, like a lot of other things, started dropping in the month of August, and they've been dropping a lot more. They just crossed their 50-day moving average. So bye-bye bull for RH, which is Restoration Hardware. Now, look at this one, because this one drops into earnings too, and the rush to get to the short side for option traders has already started to rise. Now, how do you play these 3 stocks? All right. Once again, I was talking about Titan, TITN, Smartsheet, SMAR, and Restoration Hardware, which is RH. This is short-term stuff, folks. You look at the technicals, you might think there might be something here for the long term, but you don't want to get too long-term anything on the short side, because the markets have proven that the long-term way to make money, Chris, am I right or wrong, is up.
Yeah. You don't get too many years like 2022 where everything goes down for 12 months. Usually the random walk leads higher.
It does, and it also is. It takes a lot longer for that to happen. So the short side is short term. So when we look at these 3 and they're bearish, we want to think about these in short term, 1 or 2 week blasts. So I think of them like scalping tickets. All right, the hottest ticket this year has got to be the Taylor Swift concert. Now, I'm not a Swiftie, I like some of the songs that she has, but I'm not a Swiftie. And as I sit here and go through a collection of Taylor Swift songs, she's been around a while. Are you a Swiftie, Chris?
Tom, I couldn't name a single Taylor Swift, and that's
Okay.
not.
I was
I'm
going to
not
say it's
proud
okay.
of it, but
It's okay. It's
I,
okay if you're a Swiftie.
I admire her. I mean, I admire her. You know, the way she's taken on the business industry, but I still couldn't name any of her songs.
Yeah. I mean,
Um,
but what I'm talking about is that if she's the hottest concert ticket,
mhm.
wouldn't it have been great to get some of those tickets at face value from the box office?
Yeah.
You know, you got to stand in line to get the face value tickets. And a lot of times those go quick too, because they're now offered online.
Yep.
But then, you know, what's even better than that is selling them. Now, what's the best time to sell something that's really, really hot, Chris? I mean, you know, do you turn those tickets and you flip them the same day? Or do you wait until the event is about to begin?
You let that event get ready to begin, so everybody
Yeah.
that wants to get in is going to pay a little bit more because it's right then.
You
Yeah.
jump in your car, you go to the actual place where the event is, you stand outside and you go, I got two.
Yep.
And you're going to get, you know, you want to do that right before the first song happens. You want to do that before the opening act, because that what's happening is now you're into the concert, and the value of those tickets can only go down as the concert goes on. So I want you to think about those three stocks I talked about, because they all have events coming up. And, you know, if we're looking at shorting the stock, or we're looking at buying put options on things like these, we want to make sure that we're out of those before the event. And the event for stocks is the earnings report, folks. So that's what I wanted to just kind of close with those three stocks as we move into our third segment of our podcast. Chris, how old are you? Are we even allowed to do we even want to go down this road? I mean, I'll start. I'm 58. I'm 58 years old.
55,
right.
Tom. 55.
55, double nickels.
Yep. I can't drive 55. Sammy Hagar.
So you and I, love that song. So you and I are Gen X. We are Gen X. I mean, 1 year older, and I would have been a baby boomer. I would have been a boomer. But I'm the OG of Gen X. All right. I'm the Gen X pioneer. I was the first year officially a Gen Xer. And that's great, because, you know, we're going to be talking about Gen Xers like we talk about baby boomers before long. You know, my mother, my mother's still alive. She's from the silent generation. Have you heard of this? The silent generation?
That's actually the name of it, or is it?
Yeah. So, okay, you have it.
I haven't. No, I've not. I mean,
yeah, the silent generation, you know, was the generation that came before baby boomers. I think it was somewhere. It ended in the 40s.
40s,
and
yeah.
So, yeah, my mother's part of the silent generation, and so I say that only because it was something I learned not too long ago. Let's talk about Gen X. So, I was reading a recent article that says Gen X. These are the folks between age 43 and 58. They are in deep, deep trouble, Chris. You know why? Because collectively, this group only has about $40,000 in savings. And when I say collectively, I'm talking about an average, which means some of them have more and some of them have a lot less. And, you know, we hear about this idea that 40% of American households can't even handle a $400 emergency.
Yeah.
You know, and then you hear things like this, that, you know, these are folks that, okay, if you're on my side, if you're on the 58 side, you know, you're thinking, you know, what's our average retirement? I mean, when you think of retirement, and I still think of it this way, 65 is that, you know, you get that retirement party, you get that watch, or you get that slice of cake, you know, usually the one with your face on it, and then you're on your way to retirement. Well, if that's true, these folks have 7 years. If they're 58, they got 7 years to make as much of a difference as possible. And then, you know, 43, obviously you have a little bit more, but I mean, wow, this, you know, this scares me for my generation. And I bring this up because, you have to think, if you're in that situation, I tell people when they get into investments, learn as much as you can. Okay.
Mhm.
You want to be a jack of all trades, and you want to be a master of one or two. And so, learn as much as you can, because nobody can manage your money better than you. Of course, also, Chris, no one can manage your money worse than you if you don't really try to gain knowledge.
Right.
You
No,
could be your own
absolutely.
best friend or your own worst enemy.
Yeah. How many, just on that note, how many of your friends are trying to do it on their own and, let's say, haven't gotten the education? Because I would
I
assume that
mean,
most of your friends have.
my friends are my family. I don't
Okay.
really have a lot of friends. I
Mhm.
mean, I'm in an Italian family. I got too many family members to have friends. I don't have friends, Chris. You're my friend, you know?
Yes.
And and so, when I look inside the family, I have to say most of my family is, because we talk about the stock market all the time. We talk about the markets. It's like we don't shut it off here. And, like the birthday party, we had 30 people. We had 30 family members at the birthday party. And that was the ones that weren't in New York. These are the ones that are down in Florida right now. I mean, isn't that amazing?
It is.
30.
It's
And then on a regular night, typically we kind of get together once or twice a week. It's 15. And people come over and they see these 15 folks at the house, if they're not family, and they're like, wow, what's the occasion? I've said, it's Tuesday. That's the occasion. But I mean, to answer your question, mine's a little bit skewed because everybody here talks about the stock market. We talk about, doubling down and saving as much as you can in your 401k and putting 20% or 50% of your money away, depending on what you can do. Everybody's always an overachiever, but outside of this, my neighbors, okay. Now I live on a farm, so my neighbors, I don't see them.
Mhm.
But the last house I was in was in a gated community, and the neighbors were all professionals, but they all drove Teslas and they all drove expensive cars.
Yeah.
And I have to wonder because, one's a doctor or one's a this or one's a that. And I'm like, all right, doctor, that's pretty prestigious. But you know what? That guy's still paying off his student loans and his medical loans. And, because they go from college to then they jump into the medical school, then
Right.
they jump to residency, which means they're not getting anything pretty much there. They really start their careers out when they're late 40s.
Yep.
And so these guys are still paying back stuff. So, I look at them and I wonder, well, what would happen if something happened to them? Um, and so, yeah, I got to say that with my neighbors, I think a lot of my neighbors were, in that category, whether they wanted to believe it or not. Here's some other statistics that I thought were really interesting too. Someone that makes $100,000 a year, 40, it was in the 40 percentile of them are living paycheck to paycheck. And I thought, well, wow, let's dive deeper. How about someone who makes $250,000 a year? 38%.
So it doesn't move.
Of people who make $250,000 a year are living paycheck to paycheck because of something that we like to call lifestyle inflation.
And that is simply whenever we make more, we just kind of tend to
Yeah.
spend more, right? I mean, we drive a Tesla instead of a Toyota.
Exactly. And so I tell people when they say, well, what's the first thing you do? I said, replace the stuff that you want with stuff you need.
Mhm.
Get rid of that expensive car, get rid of this, get rid of that, and start investing. Start with stocks. And to me, it's like indices, indexes, stocks. And then if you want to be an option trader, start long term. Don't start short term. Start thinking long term. Start thinking about long term options on the buy side. Start thinking about cash secured puts on the sell side, because these two things have the highest probability of you making a profit, and these have a higher probability of being in your favor down the road, because you're giving yourself time to be right, or you're giving yourself the ability to have the higher probability. And so any comments on that, Chris? I know you like the long-term options too.
I do.
So,
And you brought up something that's really interesting earlier, the 50-day moving average. And when we talk about educating yourself and long-term looking at something that's a little long term. One of those stats that I love, Tom, and this goes back to 2002 was the first time I did this study on all the S&P 500 companies. When your 50-day, we've all heard that phrase, the trend is your friend. When the 50-day moving average is moving higher on the S&P, when it's moving higher on GM, you name it, whatever it is, you have a 2 out of 3 chance that stock or that ETF or index is going to continue to move higher day by day. Mm-hmm. When you use a simple rule like that, you can now use a longer term outlook and forget about this day-to-day volatility that we've gotten caught up with over the last couple of years and focus on, looking up the mountain at where a stock price is going to go and then investing in it, with something that's longer term. It can be a longer term option like Leaps. It can be the stock itself. There are all types of things out there. But as you said, turn that winning percent or that chance that it's going to turn into a winner in your favor. And it's much easier than I think people think, especially over the last couple of years when we've gotten caught up in memes and all of this stuff. Keep it simple. Play that trend and go for the long term here. That's Absolutely. How you really create wealth, not just a couple of trades that maybe have put, a dinner's worth of, profits in your pocket. Man, go after. Well, let me ask you something, because this retirement, the what you're bringing up, and let's put aside the 40% that are living paycheck to paycheck, and you want to help them. And the easiest way is, as you said, take what you want and replace it with what you need, and then take the difference and invest it. Because 7 years is it feels like a long time, but it's right around the corner. 20 years is obviously something you feel you can work with. But how do you tell somebody that's trying to catch up? Let's say if they've got 10 years left, they're 55. How do you tell that person that, hey, 65 is around the corner? I think a lot of people in our generation have kind of given up on that, sadly, and said, what, I'm going to retire when I'm 72 or 75, and maybe I'll work at the Costco or the Home Depot.
And there's nothing wrong with that. There's nothing wrong with that at all. In fact, I mean, I know people that do it just simply because they want something to do. I got a friend of mine. That I met long ago. He's at Costco, and he's the guy that welcomes you in the door. He doesn't have to do it. He just doesn't want to sit around and do nothing. And I think that's really important to keep yourself engaged. But to answer your question, it's never too late to start. I'm going to get a little transparent with everybody here. So, and the reason I say it's never too late to start is this. All right. I made a huge, huge mistake right before the financial crisis in 2008. And it was not in trading. I decided all of a sudden I had to be the real estate mogul. Mm-hmm. So I started buying up real estate property because I thought I want that. And then what happened was it went from buying expensive condos. I started buying expensive condos, and I bought at the height of all that money, all that free money that was going out in 2005. And by 2008, I was upside down. I was upside down in real estate. And I mean, I had some real estate that was 70%. I mean, I was in Vegas. I had real estate in Vegas that just got decimated. And here I am in 2008, and in the turn of 2009, I'm like, wow. I start looking at what I paid for these properties in different parts of the country. I couldn't have picked worse places. So I'm telling you, folks, I'm being transparent that it happened. It happens to any of us. It happens. But you know what? This was let's say 2009, 2010. I was 45. I was in the area that I was in, right in the sweet spot of where Gen X's are right now. So I was there, and I was walking around. I remember I was walking around, and I saw this homeless guy, and I'm looking at him, and I'm like, damn, on paper, he's worth more than I am.
Yeah.
And so, I didn't give up. I thought, okay, how am I going to claw myself out of this mess? And I did. And I realized something that, that there's no better investment than one that you can get out of like that if things turn on you. Okay. And that's what the stock market is. And that's what options included. Right. And the other thing I realized is that I need to stick with what I know more than anything else. and I did not know real estate. And I thought, you know what? Okay, so we got a few things now, but I'm not over leveraged like I was then. Somehow I decided I wanted to be the real estate mogul because everybody else was doing it. So to me, that's where we want to, number one, Chris, it's never too late to get started. Number two, learn all you can, and I kind of hope that that's what a lot of you that are watching this podcast, have been watching before and listening to Chris and I, because, we can, and number three is get a good mentor. And hopefully, Chris, you and I, maybe we can be part of that mentorship for the folks that are joining us, whether you're here for the first time or whether you are going to be coming back. And speaking of coming back, as we end this podcast, come on back next week, folks, because we're going to be talking seasonals. We're going to look at the month of September. We're going to see September kind of looks like one of those in like a lion, out like a lamb months. And we'll talk about that. We'll share the details with all of you when we get back here again. So, Chris, we have got to close it up, buddy. So thank you. Thank you for joining again.
Never enough time, man. I love it when we do this, Tom. It's always fun.
There never is.
It really is.
I'll see you again next week, Chris. So Chris and I will both see you again next week as we dive into the month of September. Bye, everyone.
Have a great week. Bye-bye.